Globerman. Uczyłem się polskiego trochę, ale nie mówię dobrze. So, więc będzie po angielsku. May I have this? Thanks. Before I start, welcome, good morning. I'm very honored to be the first person to speak today, or the first presentation, I should say. By a show of hands, how many of you are investors or represent investors, whether seed fund, angel fund, VC fund? Okay, so four or five. And how many of the rest of you are either involved with your own business or working for a very small company? So about 2/3 of the audience. And how many are students? How many students? Okay, so about a quarter investors, a quarter students, and the rest are SMEs. Awesome. So I've got about 20 minutes, and so I have a tendency to talk very long, so I'll try to shorten myself. What I was asked to talk about today was essentially how to take your business and expand it without losing control. Honestly, that's a very difficult topic and one that we could talk about for hours. And I think the best way to approach it is to talk a little bit about investing capital from the investor's point of view and contrast that with the entrepreneur's or the small business owner's point of view. I will step back for a second and tell you that my presentation will be on SlideShare under the Globe 11. So if you'd like to access the presentation, you'll be able to do it there. And I presume that you might be able to do it as well on the website of the conference. I'll just speak for 30 seconds about myself. I'm from New York. I'm born and raised in New York City. My roots do go back to this region from about 3 generations ago. I have great-grandparents who are from Hungary, Poland, Russia, and Turkey. I studied mathematics as an undergraduate. That's my formal education. And I started my career in media advertising, where I worked on behalf of very large global companies in the packaged goods sector as well as in the banking sector, but specifically from a media advertising perspective. I went back to school because I realized I really didn't know much about finance, and without really understanding finance and accounting, I came to the conclusion that I needed further education if I was really going to advance in business. So I studied finance and management and went on to work for essentially a startup myself. And I spent about 7 years working in private equity in New York, predominantly focused on the SME, small to mid-sized enterprise market. Not startups per se, but more established companies that were demonstrating positive cash growth and were EBITDA positive, or essentially operational cash flow positive. And we were typically investing controlling stakes into these companies, not minority stakes. About 3 years ago, I found myself coming back and forth between Warsaw and New York, looking for some opportunities outside of the United States and how I could translate my skills that I had developed in New York. And I decided that Poland was the place. After doing some diligence, I decided that Poland was the place for me. And I'm working under the company brand, my startup, Global Group Ventures. And essentially, what I'm trying to do is assist SMEs in terms of understanding and educating them in the capital raise process, and ultimately helping them with the capital raise process. And I'll comment more on that in just a moment. And everybody asked me why I chose to come to Poland. And I would say that from the perspective of this conference, the most important reason really relates to the elements or the ingredients to create a successful investment ecosystem. And there has been studies, whether it be by Ernst & Young or other VC professionals like Pitch Johnson in Silicon Valley, who does invest here through Giza Capital. There's a lot of evidence that Poland is becoming a better and better market for the investment community and is improving in terms of its ecosystem. And if you look around these ingredients, Poland vis-a-vis the rest of the world actually ranks quite high. The talent pool is improving. Corporate governance is quite good for doing business, though it can be somewhat bureaucratic at times. The availability of capital is improving dramatically every year. I see more seed funds, more early stage money, the money coming from the EU to support startups and technology innovation is a great cause, and the efforts of organizations like KFK as well are really just bringing more money into the market. So it's really helping fuel the fire of the investment ecosystem here. So for those of you who are students and those of you who don't really know what the sort of external funding continuum looks like, it pretty much looks like this. Most companies, the typical company does what we call in English, in the United States at least, bootstrapping. And bootstrapping basically means you just find the money however you can. In your shoe, right, in your shoebox. You ask your parents to help you, your friends, your family. In Poland, we also have a really good grant system that's been developed, and there are now a new thing in the market, many contests that I recommend you that are considering to start your own company explore, because a lot of contests do in fact have prize money, which can be used as seed capital. Beyond that, the typical investment continuum goes angel or seed round, and then venture A, B, and C rounds. Then we talk about private equity capital in the more traditional sense. And finally, the public markets, which is typically seen as the least risky of all. And here are a number of organizations in Poland that are operating at various ends of that continuum. And I have a gap in the middle very purposefully because it's my belief that the one thing that is still missing here in Poland is good B and C round VC financing. There's a lot of angel level financing. There are some great companies at the sort of more buyout stage of private equity like Innova Capital, Enterprise Investors, and others. But when companies need more than €500,000 to €1 million, let's say, to actually fuel their expansion, it becomes more and more difficult to find it here. Hopefully that will change, but that seems to be the case what we have today. So let's step back again to the presentation's title, which was expanding and without losing control of your business. What does that exactly mean? I mean, you have to ask yourself that question because control is a very relative word. And I think the comment I want to make on this slide is that factually, if you are going to ask for some type of asset, whether it be money or other, you are going to have to give up some type of control. There has to be some consideration for that. That consideration, however, could be structured in a number of different ways. And I will tell you that also there is a difference between financial control and operational control. So fuel for thought. You can give up some of the financial consideration without giving up all of the or as much proportionally operational consideration. In other words, there are some investors who want to be more actively involved in your business than others. And if your interest is to continue running your business in as autonomous a fashion as possible, you may want to consider looking for investors who in fact are not interested in the day-to-day operations of your company. So on the flip side of that, there are other investors, like the one I used to work for, that want to be extremely active and involved with what the company's doing week in and week out. So I think that the answer is aside from you reflecting upon yourself, the question, how much control do I want to give up? You have to first look at yourself in the mirror and ask that question. And once you've decided, you've got to find an investor that matches that. That's, in fact, if you even need an investor, which brings me to another point. I want to make the point that not all good companies, successful companies, need to go the route of bringing an investor in. In fact, I've heard, I won't stand here in front of you and say that I agree with this 100%, but I've heard people stand up and give presentations that say, oh, bringing an investor into your company should be the last thing you do. Meaning after you've gone through every other possibility that you can in terms of financing your business. Okay, that has some merit. The point is that there are many successful businesses that are able to thrive without bringing investors in to actually fuel the growth. So let's talk for a minute, especially for those of you who are not familiar with the investment scene. I have a couple of slides where I want to talk about life from the investor's perspective, because I think that to answer the question about giving up control or engaging with investors in general, you have to understand how investors think. The first thing is how a fund works. And essentially, a fund starts on the upper left where money is raised. Money is raised, so it's important that you understand the person that you meet representing a fund usually represents less than 10% of the financial consideration of that fund. Not always. There are people who represent their own money, right? There are all sorts of situations, but often funds, the person who runs the fund or manages the fund is a minority stakeholder in the fund itself. The money is raised by a number of different constituents. So he or she who you're speaking with is not, in fact, must think not only for him or herself, but for everybody else, all of his or her other limited partners. That money is taken, and that general partner, as we call it, that person who actually would be engaging with you if you're an entrepreneur and he or she is looking to invest in your company, we call a general partner, who then invests in portfolio companies. And then, okay, well, then the question is, well, what's next, right? Investors are not in business with you as an entrepreneur as a long-term, typically, well, theoretically not at all, in a long-term type of commitment. They're investing money, hopefully to see some return on the other side. So typically these funds have closed ends to them, where they need to divest their position in order to actually bring that return on investment back to the limited partners. And that we call liquidation or sale. That comes in some type of exit. When the money comes back to the fund, the money gets redistributed back to all the limited partners. And then this cycle goes on and on again. So what's happening in that cycle is time is going by, right? Time is going by. And time equals money, at least we like to say that in the United States. And you have to understand that from the, if you want to start your own company and to you this is a business that you expect to try to build over the course of your life, your time continuum is very different from the investor's time continuum. However, I'll also say that when we're talking about early stage companies, investors understand at the early stage that it does require some time for those investments to pay off. And factually, there's data that demonstrates that most VC funds, first round particularly, do not start showing any return on investment for at least 2 years. So understand, if you're an entrepreneur, understand from the VC or the investor's perspective what their time frame looks like. How do they see the world? And it's important that you engage in that conversation if you're trying to raise capital. Now, the grim reality of investing in early stage companies. The fact of the matter is that most, actually 3/4, and of course this number can be debated, but there's factual evidence that 3/4 of VC or early stage investments in fact don't pay off for investors. That's just a fact. And now here's the one caveat to this. it doesn't mean that those companies that don't pay off for the investor are necessarily bad businesses. They are just bad investments. They perhaps were not companies that were worthy of external financing, in fact. So I will explain more about that right now. And it really starts with this question. What kind of business do you aspire to be? Because, you see, I was thinking about this about half a year ago. That in fact, there's two kinds of businesses in the world. The first kind of business, I would say 90% of companies that exist, maybe more, fall into that category. Lifestyle business, lifestyle business. So while I think the photograph is a little overstated, I'm not trying to say that lifestyle businesses are not difficult and require hard work. But what I am trying to say is that there are businesses that could be run for profitability, and there are businesses that are running for long-term sustenance, right? To try to sustain the business over a long period of time. If you own a business and that business is paying you a nice wage every year, and there's a very small profit at the end of the year for you, that profit could be seen as a bonus, and life is good. There's nothing wrong with that. On the other side, though, investors, outside investors, are looking for companies that, I'm just coining the phrase 10x businesses, and I borrowed this term 10x businesses from a very good book called Good to Great. Essentially what I'm trying to say here is that for investors, for an investment to pay off for the investor, the company has to demonstrate material growth. It must grow. The investor must see that profitability, right? From the owner's point of view, or shall I say the entrepreneur's point of view, they look at the world as both the profit at the end of the day and perhaps their salary or whatever other compensation they're receiving from the business. The investor doesn't share in that, except it just shares the profit portion, excuse me, right? So the fact of the matter is, for the return on investment to be great enough to actually implement the investment, the returns have to look great enough. So what does that mean then, in fact? Lifestyle business, 10x business, who has control of that? Well, to answer that question, I will just pose another question or another point that I was introduced to about 15 years ago when I was or 10 years ago, when I was in business school. What are the top 5 things that investors care about? And I thought, as I was sitting there in the classroom, market share, profit margins, global expansion opportunity, all kinds of things, the business plan. And the answer was the following. Okay? It's not just the management team number 1, it's the management team number 1, 2, 3, and 4. Okay? The management team runs the course of what's going to happen. And the management team ultimately is deciding if they are running that business as a lifestyle business or as a hyper-growth business. So the management team, in fact, becomes the most important thing, most of the time, that an investor is investing into. So I'm a little short on time. I wanted to give you one case study of a successful Polish entrepreneur. I don't know how many of you know the company Topic Marks. It's essentially was founded out of Krakow about 6 years ago, and I'll just run through the story very quickly. Essentially, Jaro Działo founded this company as a group of outsourced programmers in the south of Poland. They had they got some initial traction with some early clients in Switzerland, and first in the banking sector and then in the film industry. They then caught the attention of Hollywood and had created a technology which a couple of Hollywood distributors were interested in. So they actually created the same product that they had made for a Swiss film company for a California company. And from that, though, they saw that what they discovered in that was that they needed to get out of the consulting business and into the product development business. They pivoted their company and ultimately applied for Seed Camp in Copenhagen and won the competition, which brought them a lot of additional PR and publicity, which led them to their first external investor, an angel investment out of Switzerland, who invested 200,000 Swiss francs into the business. And they saw this as an opportunity to expand out of the EU, and they immediately went to Silicon Valley. They left production and the real IP, the programmers, here in Poland. Management and sales went to Silicon Valley. Ultimately, they found, after about 6 months, a VC group in the US. And the story ends extremely positive, where Tagged, which is a competitor to Facebook, acquired 100% of Topic Marks for a valuation that is not disclosed, but I will tell you that Jaro made out very well. So he's back in Krakow looking for his next project and traveling the world. So, and there's more and more stories like this, and there's many companies now, and by the way, Jaro and the initial team maintained full control of this company all the way through to the acquisition by Tagged. And there's several companies now that I'm talking to that are looking to repeat this type of story. This sort of didn't format well, but a couple of the lessons learned by Jaro. The investors were telling him, dominate the niche and bring them 100x returns. Forget about 10x. Hyper returns. Jaro's advice was get out of the office and talk to your customers. Think of your customers as your partners. And as soon as he thought he had solid US connections into the VC community, he was wrong. It took a lot of time to cultivate those relationships. So finally, let me just on one slide summarize what I've been saying for the last 20 minutes. If we take the investor's perspective and juxtapose it against the entrepreneur's perspective, this is how I see the world. On the investor side, am I acting in the best interest of my partners? Are the limited partners who have invested money into this fund, am I acting in their best interest as opposed to mine personally? Is the management team competent and committed to the project? Very important, especially with startups. Is this company capable of those hyper growth returns? And what exactly am I financing? Am I financing some type of IP that's being developed, something that's patent pending, a service business? And finally, my time horizon is finite. Whereas on the other side, the entrepreneur is asking themselves, are we prepared to give up part of our company? How committed are we? What kind of business do we want to be? Which is probably the most important question. Do we need the financing? Do we need it? And how much do we need? And what for exactly? And finally, what is our time horizon? Because I used to have the word infinite on this side of the slide. But in fact, I now see many entrepreneurs that are not taking an infinite look at the way they see starting businesses. There are a lot of people who want to start a business and then start another business 2 years from now and start another business 2 years after that. I think you, as an entrepreneur, have to look in the mirror and ask yourself, what is my time horizon? I recommend these books. Great by Choice is awesome. The Lean Startup is a Bible in the startup community for any of you students or for anybody who's looking to start their own company in the near future. I'm a big believer that too many people don't understand finance and accounting well enough. They leave it for the finance guy in the business, and there's several business owners that just don't have the right grasp on finance and accounting. It's very important that you understand the money flow. Accounting is the language of business. Don't ignore it, please. And finally, Breakthrough Entrepreneurship is a great book that just came out this past year. So, final few thoughts. One, give up only what you need to. We talked about, we talked about control. You've got to decide what You've got to decide what, in fact, you need. If it's capital, if it's operational expertise, that may change. The type of control that you're willing to give up. 2, sorry for the formatting. Financial control is not the same as operational control. We invested in a company once where we were financial investors and took a very passive role on the operational side. Understand what drives investor behavior. We've been talking about that for the last 10, 15 minutes. Find investors who will be the best partners, right? So it's less about giving up control. It's more about finding the right investor from a partnership perspective. And with that, I will say, bardzo dziękuję. And I don't know if I have any time for questions, but I'm happy to answer any.
2 questions.
Okay. 2 questions? Anybody? No questions?
What are the 2 main differences between the perspective of the entrepreneurs here in Warsaw and in New York?
Ryszard Gwozdowski, Firm Value. What are the 2 main differences from an investor perspective? In the perspective New York City and Warsaw.
Value on the topic of valuation,
yeah.
On firm valuation?
Please.
What stage? Early stage? Later stage?
What you are involved in?
Uh-huh.
Is there a difference?
And are we talking about, is the target company in Poland or just more generally?
If I'm the same company in Poland and a similar company in the US, would there be a difference in the approach the company take?
I think that if we're talking about a US company, a New York-based company, investing into a Polish operation, from a valuation perspective, if you just think about it from a risk-return perspective, right, the equation goes, the more risk, the more return you have to build into the whatever equation you're creating for valuation. And the fact that by it being an offshore company increases risk to some degree. Of course, it depends on what the future business strategy of that company is. For example, if you're investing in a Polish company and your investment thesis is that company will expand out of Poland and its goods or services will be adopted globally, there's obviously more risk in that actually coming true or not, yes? So there's just built-in more risk to that investment proposition. So in fact, then, in reverse engineering, the valuation, there will be valuation consideration downward for making that investment, vis-a-vis making an investment in the United States with a US company, with all other things being equal. Beyond that, the only comment I will make to you that I've heard from talking to many people is that, at least today, Polish investors generally I've seen to take a shorter-term view of the investment cycle, and are looking for a shorter-term payoff. Whereas in the United States, you have more investors who might be looking for greater returns and greater possibility, those 100x returns, and are willing to wait a little bit longer to actually see that come to fruition. Anything else? Okay, thank you very much.
Maybe later.